Hello and welcome to Trading the Trend, and that could also be a bearish trend. So we welcome you here today on this Thursday afternoon. A little rainy here in Salt Lake City, but the weather's been quite nice. So we welcome all of you here today. We got JP with us, Gary, or GT I should say, JP for Josh Pink, Spanish Johnny, we welcome him, Sharon, Silas, Amy, Bill, Jeff, Wiley, best behavior Wiley, we're watching you. Got to give you a tough time. Someone has to. And also Ocean Life, welcome. We also have Scott Thompson with us in the chat. You'll see his initials ST. We welcome him as well. Now, remember, you can follow us coaches on X, formerly known as Twitter. We post educational updates, also examples, not recommendations, and kind of what's happening in the marketplace, etc. on X. So take a look at that. I do also post my scripts right at the top of my page on my X feed in the pinned tweet. So if you said, where's a kind of a cumulative list of those scripts, they're right on my X page. Now, just real quick as we get started, remember, we're going to talk about stocks and options. Remember, when we bring up options, remember that options carry a high level of risk, not suitable for all investors. You might kind of really have a foundation of stocks, which is great, okay? We'll talk about, as we usually do, how might options help, perhaps, a stock portfolio. When might the investor consider blending stocks and options? In what circumstances? What are some pros and cons and risk? We'll talk about that. Remember that also the information here is provided for general informational purposes only. This webcast discusses technical analysis, but like yesterday, we talked about fundamental analysis. And really, there's other analysis like macro analysis, like GDP, retail sales, consumer confidence, manufacturing data. We also have intermarket analysis where we talk about different asset classes, whether it's commodities, fixed income, stocks, you name it. How are those asset classes moving together, or are they inverse? What's the correlation there? So the technical analysis is just one way to kind of look at things only. Now also remember, we will be using the Paper Money software application for educational purposes. Also remember that that Paper Money account, it could be real or Paper Money for the software-based version that we're talking about, okay? There's web-based, there is a web-based platform as well, not just the software, so be made aware of that, and mobile, which you can download as well. Remember that investing involves risk, including loss of principal. When we talk about short options, those can be assigned at any time up to the expiration, regardless of the in-the-money amount. We're talking about American style options, okay, not European. Last, remember that option Greeks, we're going to measure a sensitivity to something, as you'll see there. We'll talk about that. And also remember, coming up, we have the Scottsdale event. Many of you actually attended that. That was a great event, as you saw actually in the post from Ben and Joe Mazzola. Also, the Chicago event is full. But last but not least, coming up, Detroit, the 11th and 12th, first day technical analysis, second day option strategies. So feel free to join us. Those are, if you go to schwab.com/events, those events are listed until the end of the year. So we invite you to actually come to those events. Those are free. Now, also remember that today, what we want to cover here today is, yes, we will look at markets. I want to talk about kind of correlation just real quick. Okay, what are we seeing in terms of market sectors and different asset classes? I think that's important because we're trying to find the trends, right? Second, I want to talk about just real quick dollar cost averaging into positions. Want to just give a quick example on that and why an investor might kind of consider that and not doing the whole position at once in more volatile markets. Second, we're going to go back to kind of married puts and the short synthetic example that we talked about on Tuesday. And then also we'll look at a bullish or two example, okay? So it's going to be a blend today of bullish examples, bearish examples, past trade examples, new trade examples. And along the way, we're going to actually answer some questions, which I already see those. So we're going to get to that now. Now, first off, when we kind of pull up the platform, right, the first thing we see on the left-hand side here, and we're not trading this, we're just looking at the price level, something that kind of catches our eye. We see, for example, that if you looked at, let's say, silver, and we're just, again, looking at the price, silver actually here today went up to a brand new high, okay? We said yesterday that you maybe gold, silver, and copper kind of really becoming its own new sector. We see gold here, okay, almost touched 3,000 an ounce. We'll come to that. We'll come back to that example we talked about yesterday afternoon in the fundamental class. Almost $3,000 an ounce. Just kind of makes you realize that the wedding ring you gave to your wife or husband, not only is that person very important to you, but that ring is also very important to you as well. Okay, well, let's move on. Now, you're also going to see that when we take a look at, let's say, copper as well, we did see that also break to almost $5 as well. So precious metals here are pretty much the standout. When we actually see, let's say, crude oil, not as much of a standout. So as we kind of get to some more volatile times in the equity market, we're not seeing that translate to crude oil prices going higher. Matter of fact, they've actually been going down. They went from 80 almost down to, well, they went down from 80 to 65. So a pretty big decline when there's more volatility in the market. When we come back to the VIX real quick, can anyone tell me where we said the level was from yesterday that we wanted to keep an eye on? What was the level? Okay. Now remember, when we actually have a bullish upward trend in the VIX, that's usually a bearish downtrend in the S&P 500. Shouldn't be a surprise. We should also be surprised that when we actually see one-day pullbacks fire back up to the upside, one-day pullback, push back to the upside, one-day pullback, push back to the upside. We have bullish momentum on the VIX, which means bearish momentum on the S&P 500. Now, the level that we talked about yesterday is if we can stay below the 25 level, we could start to see volatility come off a little bit. Perhaps, maybe, could, potentially. That's not a recommendation, okay? So now, if you take a look at this, here we are. We got down below the trend line, okay? We want old support becomes new potential resistance. And could we actually see kind of us make a lower high? Now, remember, if you get a lower high on the VIX, then that actually probably means you have perhaps a low established, perhaps on the S&P 500, and or a higher low on the S&P 500. Hallelujah! Okay, I can just hear someone say that, okay? That, my gosh, if we made a higher low or just stopped going down on the equity markets, that would feel interesting. Now, so first thing is volatility. Remember, as it becomes higher and higher and higher and higher, you got to get those investors to be willing to pay more and more for the puts. Now, if the puts are more expensive, you got to have a bigger drop in the market to get to break even. So on a probability basis, it becomes less and less likely that those outcomes to buy puts becomes profitable, okay, at break even. So there does become a point where even if someone thought the market was going to go down and they put money behind that capital, they might not get as big as move as they thought, okay? The higher that the volatility goes, the more interesting the setups become for a bullish investor. Go back and look historically over the last 100 years, okay? And that doesn't mean that all of them are going to turn the same. That doesn't mean that all of them are going to bottom, okay? All of them are going to trend the same, but there should be something that's getting a little bullish push or starting to. Now, we're going to look at that. Now, when we also take a look at the S&P 500, for the S&P 500, the decline that we've seen lately has been the fifth fastest decline down since 1950. Congratulations, you've made it, okay? So for the last 75 years, this was the fifth fastest decline. And if you got stopped out up here, up here, up here, up here on some of your positions, if you get stopped out, you just kind of wanted to keep going down to make it feel better about your exits, okay? And boy, has it done that. Now, the question really came up in the chat regarding the stochastics. Last Monday, we talked about the stochastics. And the simple way to kind of look at the stochastics is, why is it not coming out of the oversold area? And it's an easy answer. So every day has a low and there's a high, okay? And then also with that low and the high, we know that there's an open price and there's a closing price, okay? On the left is where it opens, on the right is where it closed. This is a classic bar chart, right? Well, if we looked at this, if we got something where we just kind of kept closing closer to the low. Okay, so let's go back to a little bar chart here. Okay, so here we are here. Now, that's the low. If we close closer to the low, what is the stochastics going to be doing? It's going to still be down. If we close closer to the low, what's the stochastics going to be doing? It's still going to be down. Closing closer to the low, closer to the low, closer to the low, at the low. So when you see the closing price closer to the low of the trading day, the stochastics is going to be probably pressed down in the oversold territory. And that's why, how come we haven't come out of the reversal area? Because we can't get that many days in a row where we're closing closer to the high of the trading day. So the stochastics is saying, if we can't get out of that oversold area, we're spending a lot of time where we're closing closer to the lows of the trading day. Now you got to remember something, the stochastics is not a one-day indicator. It's a 14-3 setting. So it's not about well, on this day, how come the stochastics didn't go up? Because it's not a stochastics for one day. Okay? It's a stochastics, a 14-3 setting. It's not about what happens in one day. It's what happens on average over those days, plural. So that's why this, now, by the way, the stochastics has kind of told us here, be very careful that those bears, those nasty bears, boo bears, I'm not saying Chicago Bears, okay? But those bears have been very bad to those bulls. Say sorry, okay? Now, when we actually go back and take a quick look at this, if we go back to candle chart, let's kind of talk about just real quick correlation for just a second. Now, Lisa made the comment, when you get the market to decline, and it declines like a lot, one thing that you're going to kind of notice here is if we brought up a, this is not a custom script, okay? This is, you can just add to this, go right click on the column heading. We're on the market watch and quotes, okay? And all we did is we can right click on any of the headings here, go to customize and search for correlation. Correlation to what? The default here is correlation to the S&P 500. And how would we know that? Well, if you had an SPX in a list and the correlation is 1, you'd only get to a correlation of 1 if it was correlated to itself, okay? Now, you're going to notice something here. If the market were to go down steeply, these sectors would have a higher correlation to 1, okay? So scale would be -1 all the way up to 1. -1 being inverse correlation, okay, which I'll show you in just a sec. And then +1 is mean it's mimicking the S&P 500. Well, discretionaries has been on fire. 0.99 means if the market's been going down, so is the discretionaries. You're going to see communications very high as well, okay? Transports, technology. Real estate has also been dropping as well to a degree. Financials have been very high correlation. We also see the industrials, very high correlation. So what happens is when the market goes down or up, you actually have a higher degree of correlation. Now, if we go back to trend, we do not see this very often. If we see trend number 1, that just means that when we look at these, scripts not guaranteed for accuracy, verify, have an understanding what it's looking at to check. They're all trend 1s, which means they're below both moving averages. Okay, now we got to kind of state this for just a sec. What would give us maybe perhaps an inverse correlation? So going back to the gold example, notice that gold has a -0.7 correlation. If I pulled up a stock, AEM, you're going to see that also AEM has a negative correlation. So when markets are going down, the investor is saying, look, I don't want stocks or sectors or something that's correlated to the market. I would like something that's showing an inverse correlation. Okay? So I don't know if you can kind of tell, but I kind of pay attention to that. Yeah. Now, by the way, that could be used for asset classes. That could be used for many things. Okay? Now, what I want to do is I want to kind of talk strategy for just a second. So when we look at the S&P 500 just for a moment, is where are we going to? I mean, where's a level where we might say, hey, it looks like it might kind of flatten out a little bit. Well, we thought it was going to be 5,600. Denied, not even close to a bounce. Next level, please. Okay, 54.20. 54.20, another 100 points, about 2.5% down. The divergence we talked about last Monday, it broke down. When those divergences don't hold, it's what we call the path of least resistance. Okay? And if the first level doesn't hold, it's going to seek and destroy typically, perhaps, potentially, could, maybe. Okay? Vielleicht, if you speak German, same thing as maybe. Well, what you're going to see is it just tends going to fall down to the next level, which is 54.20. And so that divergence never materialized in terms of a trend change, and neither did it get out oversold. We're not getting mixed messages. It is just saying no, 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 no to the bulls. And that's why the bulls haven't come out. There hasn't been anything really showing continued strength. Any questions with that? Now, this is very important that we understand this, because a lot of times people think, well, the market goes up and down. We don't care if it goes up and down. We want to know what the trend is. And if those moving average lines are red, the trend is down. If that color shading is red, the trend is down. And so far, it's been right. Okay? Now, what I want to do is I want to go back to kind of just talking about strategy for just a second, okay? So in a more volatile market, I think dollar cost averaging, okay, I think it's important, okay, dollar cost averaging. So what I mean by this is if you said, hey, James, I normally buy $6,500 worth of stock. If you bought it all at once, you might say, I'm not going to put it all in at once. I'm going to do a half position, maybe another half position, etc. Okay, so why might an investor kind of do dollar cost averaging? Well, because that first entry that you made, that might, if you have a more volatile market, that means in the shorter term, it's going up and down, up and down, up and down. You might have a better chance to buy maybe at lower potential price levels. Okay. Second is if you get in, sometimes you might, in the next day or two after that, have the price fall down. And you're trying to say, look, if the first entry is wrong, I want it to be wrong on a lesser amount of capital. Okay. Now we're going to come to this, and I'm going to kind of put a little asterisk here, ATR. Okay. And let's just kind of hold that thought for just a second. Now, over the last 2 weeks, we've been talking quite a bit about married puts. Now, it's not that we like puts. That's not the point of the married put. Oh, we like the put. That's not the point. The point is to define risk, as we'll see. So a married put is just buying the stock, okay, buying the stock, plus a long put at the same time, okay? And so this gives us a defined risk, okay? We're going to come to that. The other thing is, as we talked about on Tuesday, which is if there is a bearish trend, how might the investor play that or consider trading that trend? Well, I mean, look, we've talked about short call vertical, okay? We've talked about long put vertical. That's not new material, okay? But where I want to kind of add that or be kind of just expound upon that is that short synthetic, okay? Short synthetic does not require stock, okay? And it really is just a short call, and I'm going to label this short wide. Well, let's just label it like we did. Short call vertical, okay? Short call vertical plus, by the way, that's a credit. And what we're going to do here is we're going to add the long put. Now, why did we talk about that? Well, I don't know how many of you have ever been in a vertical where the stock actually goes down in your direction and you thought to yourself, man, I wish I could have made a little bit more. Well, that's kind of where we go to a strategy where the delta is a little bit higher negative, okay? I want to kind of come back to that. So right now, I want to kind of talk about this dollar cost averaging, okay? Number one. Two, we're going to take a look at a married put, Just make sure we practice that. And I will also look at current examples that we have in the portfolio. And third, I want to go back to this idea of a short synthetic and the example that we did the other day on Tuesday of Nike. So let's go back on it, okay? So first off, let's go back to this example on AEM for just a second. The paper money account did get long the shares of AEM. That's not a recommendation. It's a paper money account. It was a paper money trade, and it was done for example, illustrative purposes only. Not a recommendation. Now, if we take a look at this, let's say the investor said, you know, James, I want to try to buy the shares of the stock at the current price. Now, what I'm going to do is I'm going to pull up the paper money account. And by the way, this is not new, okay? It's something we've done probably since 2005 or 2004. Scott Thompson would know as well. I'm going to right click on the chart, okay? And I'm going to go to buy custom. I'm just going to go buy custom. And for this, just for this example, I'm going to go buy custom with stop, okay? Now, when I do buy custom with stop, first thing that we have to know is, well, how much capital are you going to put in? Well, the capital that we've been kind of using as an example, if I said, hey, if I said the account value was $99,000 and we're willing to risk 0.5%, well, that would be $495. That's the risk we're willing to take if you're willing to risk 0.5% given a portfolio of 99,000. Well, if we go to, let's say, the stock price, okay, what's that stock price? Well, that stock price currently is at 101.98, okay, 101.98. Where do we see a support level, okay? Well, that support level that we looked at yesterday, check me on this, I think was probably right around the area of about 96.87, okay? 96.87. And if we took the support level, less 2%, 94.93. And what this is going to do is, if we take a look at this, what's the position size per trade? I think we did yesterday 65 or 67 shares. It's going to give us about 70 shares of stock. Now, let's imagine that when we talked about the capital size, we were doing about $6,500. Let's say we don't want to put it all in at once, okay? Well, what's half of 6,500? It's going to be 3,250, okay? Now, let's kind of go over here to the right-hand side for just a second. How does the ATR come into this? Well, the ATR is just looking at what's called average true range. It's saying how much does it fluctuate? Is it based on percentage or a dollar amount? Answer, it's based upon a dollar amount, okay? And it's based upon an average dollar amount fluctuation over the last 14 days. That's the default. Now, what we're going to do is we're going to click on apply and then go okay. Now, what you're now going to notice is it's saying over the last 14 days, the stock has fluctuated. I'm down here at the bottom left. It's fluctuated about $3.16. Now, what some people do, and I'm glad Scott Thompson's here, but some people like to kind of use that ATR as a way to kind of filter maybe where they might add to a position. Now, some people might say, James, you know, I'd really be interested in maybe trying to add to the position. So what's the entry now? Let's call this the first entry. Well, that first entry, what was that price? 101.98. Okay, so 101.98. Now, if you said, James, look, I think this market is pretty volatile. What is the ATR now? Well, 314. Well, what the investor might do is they might say the second entry is going to be one ATR above the first entry. Now, wait, why would someone try to buy the stock higher than the first entry? Answer, they want to make sure it's actually going up. So it's the first entry plus one ATR, okay? Now, you can kind of play with that a little bit, but I'm just going to keep it simple, one ATR. With the first entry, 101.98. Add what the ATR is, it's going to give us the second entry, 105.12. So that first entry was really going to be about $3,250 of capital, and that second entry is going to be the last $3,250. Now, I'm telling you, in a more volatile market, If you just get in a full position size and then the very next day the stock goes down, it kind of makes you feel bitter. Okay? But we should know that in a higher, more volatile market, at even a half position feels like a full position if you get the direction wrong. So what I'm going to do in this example, just to kind of show this, I'm going to right click on the chart, right click. We're going to go down to buy custom with stop. And we did that. I'm going to go back and kind of say, okay, the capital that we're going to put here, if we only did a half position, is really going to be 32.50. We're going to break the position in half. I'm going to tell you right now, most people, when I explain this to people, are like, why not just put on the whole position? But you just explained to me that you sometimes get in and there's volatility. Why not just cut the position? This is one way to do it. And it's not a new idea, okay? But it's a new idea when we practice it. I get it now. Now, it's going to be about 31 shares of stock. Let's just round up to 32. So if we did 32 shares of stock, okay, we got this price there, which we've been talking about. Limit is saying that price or less. And the stop, okay, we're just going to go back and say, where's that stop? The stop was 94.93. Type it in, 94.93. Now, another thing that's kind of just completely foreign to some people, it doesn't make any sense that you'd buy the stock higher. Well, you're trying to buy the stock higher if you're trying to make sure that the stock is trending, okay? So what we're going to do in this case is we're going to say confirm and send. This is a half position. So if this trade does not work, it's not losing a full 0.5% of the portfolio. It's losing a smaller amount. Now, let me ask you a difficult question. Would you like to lose the full amount or would you like to lose half? It's a question. Go ahead and answer it now. Okay? If this position doesn't work, we know that if we put positions on in a rising volatility environment, the chances of those trades working, setting stops, probably have a lesser chance. If you know that, maybe cut the position size. If you know that, maybe consider practicing what we're talking about. Now, what we're going to do is going to look at the stop, confirm. Remember with the stop, there's no guarantee of what that fill is going to be. The stop is what we call the activation price. What it fills at is undefined. We don't know yet. Okay? Send the order. Now, go back to this. We're going to go back to, for example, what was the first entry? 101.98. If I said, what's the ATR? 314. And now what I'm going to do is if I take a look at this, I'm going to say, what's the second entry? 105.12. So I'm going to go up to 105.12 and I'm going to right click right there. Right click right there. Buy custom with stop. 105.12, and we're going to try to buy the remaining-ish, about 32 shares of stock, probably about 31 shares. Why 31 shares, not 32? You got to remember, as the stock price goes higher, the amount of capital to buy those shares is going to be more. So it's going to reduce it just by a hair. For time's sake, I'm going to do 32. Won't be massively different, okay? But the stop that we're going to use, at least initially, is exactly the same, okay? Now, if we said, where's that stop again? We said the stop was 94.93. Now, if I go 94.93, there it is, the same stop we had before. So we're saying if we go up to that price or higher, buy the shares of the stock, okay? Dated GTC, and then there's the stop. So first thing to kind of think in your mind, if the market is becoming more volatile, consider downshifting. When you say downshifting, what does that really mean? It means cut the position size. When you say cut the position size, what does that mean? The amount of capital and or when I say the amount of capital, it's going to also cut down the number of shares, okay? Now, when we also take a look at this is, if I go confirm and send, now some of you might be thinking, I don't like that because I don't know what the cap is going to be. We can change that. If I didn't like that, simple way to fix it. If I said, look, you're allowed to buy it no higher than 106.12. That way there's a dollar range in which you can buy, but no higher than 106.12. Now, the narrower that you make the range, the lesser chance you have to get filled, okay? So you got to be careful with that, okay? If I put a quarter, I mean, it has to be perfect. 50 cents, dollar. Probably $1 is more realistic, okay? Can vary upon the stock prices, of course. But some people might kind of say, look, it's saying buy the stock if it gets to that price or higher, but no more than that price, okay? So probably if we did an example, we'd probably say the range would be minimum a quarter, medium 50 cents, and $1 probably the widest we would show the example. We're going to go confirm and send the order. And now what you're going to notice is that order is just sitting right there. So if this stock goes down the next day and vacillates, just kind of goes up and down, we don't have a full position. Now, one thing I want to kind of say just real quick is, so first takeaway is when that volatility, so VIX is rising, consider does not mean recommendation. Consider means contemplate. Think about it. Run it through your mind. Run the numbers, whatever, okay? Consider, okay, dollar cost averaging. I think the biggest actually thing also with this is if you have a situation where that VIX is increasing, you're going to have less entry signals per the technicals. And recognize that's okay. Because if there's less signals, there's less signals. If the market's pulling back, there should be less signals, okay? Now, what I want to do is I want to kind of see, are there any questions on dollar cost averaging before we move to married puts, current and past examples. So dollar cost, as far as the way to practice this, I want you to find stocks that you could see that are uptrending. I want you to consider going to your paper money account, okay? And I want you to practice doing where you split the positions in half. Well, James, when we go back to this, the first entry was the current price we're looking at, okay? If there's an entry right now, example given, we looked at AEM, and the filter to add to the position was just the first entry plus 1 ATR. And that order that we talked about was a buy stop or a buy stop limit. So the first takeaway from this is practice dollar cost averaging, okay? Now, so that's first. Now, second is when we talk about married pets. Now, I just want to kind of be clear on this, okay? Now, when I went to college and I went to finance school as well, and I'm going to tell you right now, I never had any classes on buying puts, okay? I can assure you that. And so the biggest thing is buying puts might make more sense when the volatility is rising. If the volatility starts to rise, the chances that the stock will break down becomes higher. A stop does not guarantee an exact fill, but a long put gives the investor the right to sell the shares at the strike price, and it creates a maximum loss. A stop does not create a maximum loss. The only way you get a maximum loss on a stock is the stock goes all the way to zero. Now, let's show an example of what we mean by this, okay? Now, example given, we have shares, and I want to go back to example given Pepsi, okay? Now, what you're now going to notice is we have an example. Let's go to just real quick, TAP, okay? This is kind of one where we bought the shares of TAP, Molson Coors, and we thought those shares of stock were going to go up. Wrong. The stock goes down. Now, I know that never happens to you, but in the paper money account, that's exactly what happened. And so if we get the direction wrong, we see that we're down to 459. Okay, now, what you're now going to see in this case is in a married put positions, you really you have two positions. The first position is the shares of the stock. Yeah, no kidding. The second position is the protective put. So when we say the protective put, that means we bought a put, and that buying the put gives us the right to sell the shares at 60. Okay? Now, when we put this put on, it's normally going to be with a monthly expiration, 20 to 50 days to expiration, with a delta of, let's say, 30 to 40, something that's out of the money. What does that even mean? Well, what that means is if we buy the stock at 63-ish, the put that we buy is going to be below. Think of the put as a safety net. The bought put is a safety net, okay? Now, how long are we going to hold the put? The answer is all the way until the week of expiration. We're going to try to let the probabilities play out that the stock perhaps could actually go up, okay? And this creates the maximum loss here. So we don't have to fret and say, oh my gosh, it's horrible, the whole 9 yards. The biggest thing is if this stock is, which it currently is, if it's below 50, it's at 58.81 now. If we have a right to sell it at 60, we don't have to panic and say, oh God, it's so horrible, because we have a right to sell it at 60. Even if it goes lower and lower and lower and lower and lower, the loss actually is becoming less and less and less per our discussion on Tuesday. Okay? So if I looked at this position and said, what's our delta on the position now, net? Answer is 43. The gamma is actually 8. So for every dollar that we drop, the delta is going to drop by approximately 8. So the first dollar drop, $43 loss approximately. Second dollar is going to be 31. The second dollar drop, 23, and so on. If it drops more and more and more, the loss is not bigger and bigger and bigger. The put becomes more and more protective. Okay, now I want to kind of show a different example of this. Okay, let's kind of talk about a new example. Now, when we talk about like a protective put, and here's the thing, as an educator, okay, I need to kind of make sure that you kind of get practice in doing these strategies, okay? So let's say the investor said, you know, James, I want to go back to a stock, and I'm just looking at something real quick. I'm going to look for a stock that might be a little bit lower in price. Now, I'm going to try to choose a stock. Now, the reason why I said that comment is I'm going to try to choose a stock where we could buy 100 shares of stock, okay? So when we do married puts, we're planning on that we're going to buy 100 shares of stock. Now, one of the stocks, and matter of fact, I want to go to RTX, okay? Let's imagine that we bought 100 shares of stock in the IRA as an example. So first off, how do we do it? Well, I'm going to go to the trade tab, going to click on the ask price, okay? Now, your second homework assignment is I need you to practice 2 or 3 of these. You can't be good at something just saying, I read it, I saw someone doing it. We need examples. That's what the paper money account's for. Step 1, we're going to buy those shares of stock. Step 2, we're going to go 20 to 50 days to expiration, the April 17th expiration, and we're going to pick a put on the right-hand side, put, and we're going to buy it. Now, we can see what those numbers are. Why? Because we can do basic math, okay? Now, what you'll notice with most millionaires, they can do basic math. I mean, we're just doing adding and subtracting here, okay? Basic, just nothing too hard that we need a calculator, okay? Now, what we're going to do is we're going to buy that put, okay? So how do you buy the put? So notice what we did there is when I'm going to buy the shares of stock first, check, did that. Second step, first triggers execute. Why are you doing it? Why are you doing that? Well, we're doing that because we want to do it in this order first. Buy the shares of the stock and then buy the put. Now, if I click on that, now what you're going to see is the investor could say, James, I'm a stock investor, but I want to protect my downside. So this does not mean that I'm a massive option trader. The investor is really saying, I just want to protect my capital. So in the basic math, when we go take a look at this and we kind of look at the numbers of it, we come back and kind of just say, what do we got here? Well, if we buy those shares at 128, just kind of running what that potential maximum loss could be, the shares, well, we buy them at 128.74. The long put, where do we have a right to sell those shares? 125. Remember I said the basic math? Well, we're just saying the difference between those two is, okay, $3.74. So if that stock were going to go down, the stock loss, okay, would be $3.74. But we got to also include what was the premium for the put. Well, you got to pay that, $2.49. So now if we just add the stock loss, okay, to the long put strike, I'll put X, the long put premium. And if we just add those together. Now what you see is that plus that, and we say, look, this is a loss per share, okay? Or you could say, look, this is going to be $6.23 or $623 because we're talking about 100 shares. So now, if you talk to a neighbor, now just the other day, a person came up to me and said, man, how much more do you think this market's going to go down? I just want to make sure I can retire. Well, I'm pretty sure that person didn't have any puts, okay? So the biggest actually thing is when you could kind of get people to kind of really say comments that might be emotionally charged, there's no stops, okay? There's not really any protective puts or anything like that. And what you're now going to see is what we're trying to do is define the risk. So if we get the direction wrong, it can only get so bad for a certain period of time. Now, what's a big asterisk on that? What's the big asterisk? The put is not indefinite. The put is only until the 17th of April, okay? So at the 17th of April, that could drop off, okay? And all of a sudden, we don't have a downside risk protection. Now, what we're going to do is going to confirm and send. Now, the purpose of buying the put at the same time is to kind of see if we can just kind of get this off the ground and see if it can start to trend. One of the major points of the married put is in pockets of higher volatility in the market is we're trying just not to get stopped out only to see the market go back up. And the major purpose of this, if the stock were to go below the strike price, it doesn't mean that we've locked in any losses. They're just floating unrealized losses and or gains, just like we saw in the position. But if you talk to a stock investor and they said in the last month, I got stomped out at 10, 12, 15 positions, they locked those in. Now, here's the deal. If the investor said, hey, James, I'll fix that. But if the investor said, James, I have shares of stock, but I don't know how to add the put to it, well, it's a simpler thing than that. You just click on the put that you want to buy and then just add that. So you'd have in the monitor account the stock position. And the second piece is just saying, I'm just going to add the put. So in my mind, I kind of think of a married put as when the investor is buying the stock and the put at the same time. Married put. If someone says, look, I have the shares, and then I'm later buying the put, I think the investor might say the terminology of I'm adding a protective put to my position. You could do it at the same time, consider it, and or adding it after the fact, okay? Now, are there any questions with that, okay? Now, Ray says, what if the put is in the money and long duration? Well, remember, so if we have long duration, okay, this is just kind of, now when we say long duration, we're talking about in terms of days here, okay? If we said that, okay, the stock is below that strike price, what could the investor do? Sometimes what can happen is the investor might say, James, I want to take that gain to make myself feel better. That's not the point of that, okay? The duration in our examples wouldn't be longer than 50 days because we're concerned about what the investor's paying for the put. We talked about that on Tuesday, okay? So the one thing is, if this has, when we set it up, 20 to 50 days to expiration, so if we said, hey, we're kind of in the middle of the 20 to 50 days to expiration, and if there's 35 days, what is someone going to do with the put? The purpose is we're going to try to use that put all the way into the week of expiration and or on expiration and try to see if that stock can't bounce. Now, let me just kind of say this in closing. If that stock on the week of expiration is below that strike price, okay, that's not a good sign for trend. The investor might say, I'm going to sell the put and then sell the shares. So there's a certain length of time to see if that bounce is going to happen. But if that long put on the week of expiration is below the strike and or closing below that strike, that's not a good sign, okay? Now, as we get closer to the expiration on some of these, we'll follow that kind of methodology and practice that. Okay. Now, I'm out of my time here, but the one thing I want to kind of say, the takeaway is, if we're in pockets of higher volatility, dollar cost averaging. When we talked about, for example, when we look at, let's say, the market in general, and we talk about kind of oversold conditions, we are still in those, but that oversold does not mean the market is turning yet. We will continue to talk about that. Kevin and I will talk about that more tomorrow morning on the ETF class at 9:30 a.m. Eastern. Join us. We will continue to kind of monitor that, but right now we're not getting any head fakes. It's one way to the downside right now, okay? And we'll continue to monitor that. Now, also remember that with what we've discussed, it was done for example and illustrative purposes, talking about dollar cost averaging, talking about the purpose of puts in the portfolio. And even though the investor might only have 2 or 3 of them, they could be potentially helpful. Last but not least, remember Brent Moore's coming up next on short verticals. I want to say thanks to Scott Thompson for answering those questions in the chat. And also thanks to all of you, and make sure you go out and practice. This has been the class on Trading the Trend. See you back tomorrow morning with Kevin Horner. Kevin Taco Horner, that is. Thank you so much. Take care. Bye-bye.